What if I told you the IRS could audit your business for a tax return you filed 25 years ago, even if you did everything right? You're not going to believe this, but I've seen business owners blindsided by audit letters for decades-old returns, all because of a loophole almost nobody talks about. And here's the kicker. You could be exposed even if the mistake wasn't yours. If you think the 3-year rule keeps you safe, this video could save you from a financial nightmare. Stay with me. What I'm about to reveal will change how you protect your business. Let's be honest, the tax system is a maze, and most of us are just trying to do the right thing. You're told to keep your records for 3 years, maybe 7 if you're extra cautious, but the truth is the IRS has ways to reach back much further, sometimes with no time limit at all. And here's the wild part. You could be doing everything right and still get caught in a crossfire if your accountant makes a mistake. This isn't about fear, it's about being informed so you can protect yourself and your business. If you've ever felt overwhelmed by tax complexity, you're not alone, but you're here, and that already puts you ahead of the 99% who blindly trust the first answer they get. You're not just a business owner, you're an informed insider, and today you're going to see what most people miss. Let's start with what most people believe. The IRS can only audit me for 3 years. After that, I'm safe. But here's what's actually true. The 3-year rule is just the beginning. There are exceptions, and big ones. If you underreport your income by 25% or more, the window jumps to 6 years. If you never file, there's no limit. But here's the bombshell. If your return is deemed fraudulent, the IRS can audit you at any time. And it doesn't even have to be your fraud. If your preparer commits fraud without your knowledge, you're still on the hook. Let me give you a real-world example. The Mann family filed their taxes every year, hired a professional, and thought they were safe. 25 years later, the IRS came knocking. Why? The preparer had inserted fraudulent entries. The result? The IRS claimed unlimited audit power, and the courts agreed. Imagine trying to defend a tax return from the 90s, finding receipts, reconstructing records, paying penalties and interest that compounded for decades. That's not just stressful, it's financially devastating. Here's another scenario. I once worked with a client, let's call her Lisa, who ran a successful design firm. She'd always used a reputable CPA, kept her books clean, and filed on time. But years later, she got a notice about a return from over a decade ago. Turns out her CPA had made an aggressive deduction that the IRS later classified as fraudulent. Lisa had no idea. Because her return was tainted, the IRS had no time limit. She spent months digging through old files, paying for legal help, and ultimately writing a check for penalties and interest that nearly wiped out her emergency fund. And here's the thing, Lisa did everything right. She trusted a professional, she kept her records, she followed the rules. But the IRS doesn't care who made the mistake. If your return is tainted, you're fair game. And the penalties, they're not just a slap on the wrist. We're talking about tens of thousands in back taxes, penalties, and interest that can wipe out years of hard work. Let's talk about what most business owners think versus what's actually true. What most people think: if I'm honest, I'm safe. If I hire a CPA, I'm protected. If I can keep my records for 3 years, I can relax. What's actually true? You can do everything right, but if your preparer crosses the line, you're still exposed. The IRS doesn't care who made the mistake. If your return is tainted, you're fair game. Let's look at another example. A client of mine, Mark, owned a small manufacturing company. He'd always been diligent, but one year, his accountant claimed a research and development credit that Mark didn't fully understand. Years later, the IRS audited that return, found the credit was improperly claimed, and classified it as a willful misstatement. Mark was shocked. He had to pay back the credit plus penalties and interest, and the IRS used that as a reason to open up other years he thought were long closed. And it's not just about fraud. If you never file a return, the IRS can audit you at any time. If you underreport income by 25% or more, even by accident, the window jumps to 6 years. And if you're in an industry the IRS is targeting, like construction, restaurants, or cash-heavy businesses, they're even more likely to dig deep. Let's talk about the most common mistakes I see business owners make when it comes to audit risk. Mistake number 1, assuming your CPA is infallible. I get it, you're busy. You want to trust your professional, but the reality is even the best CPAs can make mistakes, and some are more aggressive than others. If your CPA is pushing deductions you don't understand, or if they're unwilling to explain their reasoning, that is a red flag. Mistake number 2, not reviewing your return before signing it. I can't tell you how many times I've seen business owners sign off on returns without reading them. You don't have to be a tax expert, but you do need to ask questions. If something doesn't make sense, ask. If your CPA can't explain it in plain English, push back. Mistake number 3, throwing away records too soon. The 3-year rule is a myth for many business owners. If there's any chance of fraud, intentional or not, the IRS can come back decades later. I recommend keeping digital copies of all your returns and supporting documents for at least 7 years and longer if you've ever had a complex or unusual year. Mistake number 4, not understanding the difference between tax preparation and tax strategy. Most CPAs are trained to prepare returns, not to strategize. They're focused on compliance, not on helping you keep more. That's why I always say 99.5% of tax laws are written for you, not against you. The tax code is a roadmap, not a punishment, and the wealthy don't have different rules, they just use the rules differently. So what should a smart business owner do? Number 1, choose your accountant wisely. Don't just look for credentials, look for integrity, transparency, and a track record of ethical behavior. Ask for references, read reviews, and review them like you would any key team member. Number 2, review everything before you sign. If something doesn't make sense, ask. You don't have to be a tax expert, but you do have to be vigilant. Make sure you understand every major deduction, credit, and strategy your CPA is using. Number 3, keep your records longer than you think you need to. If there's a chance of fraud, intentional or not, the IRS can come back decades later. I recommend scanning and storing digital copies of all your returns and supporting documents. Cloud storage is cheap insurance. Number 4, stay proactive, not reactive. Don't wait for an audit notice to start thinking about your risk. Schedule regular check-ins with your CPA. Ask about audit risk, red flags, and how to document your deductions. The best defense is a good offense. Number 5, understand your industry's risk profile. Some industries are more likely to be audited than others. If you're in a cash-heavy business, if you have a lot of independent contractors, or if you claim unusual deductions, you're at a higher risk. Make sure your documentation is airtight. Number 6, don't be afraid to get a second opinion. If your CPA is pushing strategies you don't understand, if you're not comfortable with your approach, get a second opinion. A fresh set of eyes can catch mistakes before they become problems. I've seen this firsthand with clients who thought they were protected only to get blindsided years later. The IRS isn't just a neutral party, they push boundaries. And if that means finding creative ways to collect, they'll do it. That's why you need more than just compliance. You need strategy, vigilance, and a partner who's looking out for you. Let's be real, getting an audit notice is terrifying. It's not just about the money, it's about the stress, the uncertainty, and the feeling that you're being targeted. But here's the good news, you're not powerless. By understanding the rules, by being proactive, by building a team you trust, you can protect yourself and your business. Most business owners are trusting the 3-year rule and don't realize the risk. Every day you rely on that myth, you're leaving money on the table, or worse, risking penalties. Now you know how to protect yourself and where to draw the line. The question is, will you keep following generic advice, or will you step up and use the same strategies the wealthy do? Here's what you still don't know. The IRS just announced sweeping tax changes for 2026 that will impact every business owner. These aren't just minor bracket tweaks. These are opportunities and risks that could mean the difference between saving $10,000 or losing it. Most CPAs aren't even talking about them yet, and AI definitely isn't up to speed. If you want to know exactly what's changing, how to position your business, and the 7 strategies you need to save $10,000 or more next year, watch the next video. I'll break down the new IRS rules, the hidden opportunities, and the action steps you need to take before it's too late. Don't let these changes catch you off guard. Click through now, get ahead of the curve, because it's not what you make, it's what you keep. So keep more.